welcome to 18 Group's webinar on the emerging structure of the institutional digital assets market. My name is Sarah Underwood and I'm an editor here at 18 Group, and I'll be moderating today's webinar. Our expert speakers today are Sean Douglas, CEO and co-founder at Amber Data, Benjamin Santos-Stevens, Chief Executive Officer at ClearToken, Duncan Trenholm, Managing Director, Global Co-Head and Digital Assets at TP ICAP, and Marco Kessler, Head of Research and Development at SIX Digital Exchange. I'll ask them all to introduce themselves in a moment, but just a few words for our audience. To the right of your screen, you'll see a Slido panel. There's an area for polls. We'll be running 3 polls today, so do please take part. Interested to know what you think about the topics we're talking about. And there's also a panel for your questions. Please put these in the panel whenever you'd like to. And sometime during the webinar, we'll take some of your questions and hope to give you some useful answers. Okay, enough from me. Let me come over to our speakers and ask them to introduce themselves. And Sean, please introduce yourself and tell us a little bit about your interest here.
Yeah, thank you. So Sean Douglas, co-founder and CEO of Amber Data. We're the leading provider of digital assets data for institutions, and we power businesses that are building digital assets, building on top of digital assets, whether it be front office, mid office, or back office. Really help accelerate their time to market and save them, time and money as they go to market.
Okay, that's great. Thank you very much indeed. And Ben, coming to you.
Thank you, Sarah. I'm Ben Stevens, CEO of ClearToken. We are a financial market infrastructure seeking authorization to specifically work through the issues associated with digital assets and how they move through the financial market.
Excellent. Thank you very much indeed. And coming to you, Duncan.
Thank you, Sarah. Great to be here. I co-lead our digital assets business at TP ICAP, which is the world's largest interdealer broker and a big financial markets venue operator. We're in operation across all major asset classes, but we launched our digital assets business, which dates back to 2017, and got a couple of products in market, a crypto asset derivatives broking desk, and we operate a crypto asset spot exchange from the UK.
Thank you very much indeed. And Marco.
Hello, everyone. Thank you, Sarah. Happy to be here. I'm always head of research and development at SDX, SIX Digital Exchange. We are the first regulated financial market infrastructure operating a stock exchange and a central securities depository, a CSD, based on distributed ledger technology, located in Switzerland and but operating globally.
Okay, thank you all very much. Some great expertise and experience in the room. So let me come first to Ben. Please, would you tell us a little bit about the state of play across digital assets markets?
Yes, absolutely, Sarah. So I think it's quite easy to think about digital assets and either go down the route of tokenized securities or tokenized real world assets, or even cryptocurrencies, and just think of one of those on their own. The truth is that in some ways they're related, often running on similar technology. And we're now seeing a relation in terms of the way regulation works. The UK in particular has started to change its regulation to recognize the concept of a crypto asset independent in English common law, and that's setting the scene now for regulation across any type of asset that could be considered digital. I think we've gone from a period of what the crypto natives originally might say, total regulatory uncertainty, to in some jurisdictions very clear guidance from government on how they're going to regulate, and in other places regulation that's really coming into force. Not least with MiCA coming into force next year, and in the UK we'll be seeing all forms of crypto asset being authorized or being regulated, so that authorized firms in the UK are able to either trade them as an investment firm or list them on their venue or custody them, a lot further forward than we were probably 12 months ago, and probably a lot faster pace of change in some of these developed economies than we'd expect. And of course, though, on the other side, we've seen our fair share of lawsuits, bankruptcies, and scandals in the last 12 months. Hopefully, we are seeing some of that turning around. Not too many more of those on the horizon. But I think it's fair to say that may have scared off quite a few institutions over the last sort of 24 to 36 months. I think with the regulation coming in and the certainty there, and the understanding that you can just do what you were doing, and with a variation in your permission, you'll be able to handle all forms of digital asset. As long as you have the right technology, right partners, you'll be able to get involved. And I think that's a massive step forward for the true access of digital assets by institutions.
Okay, thank you very much indeed, Marco. How do you see the market from where you are?
Yeah, I think there is lots going on, I would say. We see more and more banks launching more and more tokenization platforms and services, institutionally focused. And mostly I'm talking about the digital securities area of things, this focus area. We've seen several studies and articles forecasting a very strong adoption in the institutional space for digital securities and digital assets in general with tokenization services. Usually the one which gets quoted the most is the report by Citibank forecasting 4 trillion of value tokenized by 2030. It's significant. We see FMIs such as ourselves, such as Six Digital Exchange, together with central banks and regulators, launching new DLT, distributed ledger technology, and blockchain-based services, or piloting wholesale central bank digital currencies. You may be aware, just last Friday here in Switzerland, there was a launch of the first regulated real-life pilot of central bank digital currencies with 2 government bonds settling in wholesale CBDC. So the real thing, kind of, not a POC or experiment. And we see, of course, a big focus in the markets looking at interoperability between all those kind of services and tokenization platforms, looking at how to interconnect these offerings and make these available to the broader market beyond a single bank's reach, so to say. I think to sum it up, I would say that all of these developments indicate a very healthy, innovative environment where you can clearly see the industry is exiting the experimentation or proof of concept stage and entering the phase of commercialization and industrialization, looking at launching new services and benefiting from those benefits which are unlocked by digital assets.
Okay, thank you both very much indeed. Many of those ideas that you talked about, we'll talk about in more detail later on. But let's run our first audience poll, if we may. It asks, to what extent is your organization investing in digital assets? So while you vote, let me bring in Sean, if I may, to talk about the extent to which he sees institutional investors involved in digital assets. We've talked a little bit about it, but when you're out in the market, what are you seeing?
Yeah, so I would say in the last year, we've actually seen a massive inflow of institutional, whether it be institutional players, from TradFi to major asset managers to global family offices and around the world, and as well as banking. And I think that think of digital assets as a continuum of digital transformation for traditional financial infrastructure and financial services, and we're starting to see that really play out now, and we're seeing a lot of the regulatory bodies around the world, except for the United States, embrace that. And I think that Ben did a good job talking about the UK and in MiCA, but you also have Dubai, Abu Dhabi, Singapore has been a long-standing player, and Hong Kong now is open for business. So we're seeing just a groundswell of greenfield opportunities around the world with very clear regulation, and they're inviting people to come and do business, and they're welcome there. So we see that that's huge. The second major trend that we're seeing is a massive move into derivatives. And with some of the bad things that happened last year, there was a lack of trust in some of the centralized exchanges that, bad things happen there. We've seen just a big move into derivatives, and specifically we've seen inflows into CME, for example, and derivatives and futures options. We've also seen, CBOE Digital, they've launched now as well. So we're just seeing, a massive influx in open interest in the derivatives contracts and in options trading, and it gives much more surgical precision in risk management. And then the third component is the banks looking to tokenize real world assets, and it's really taking illiquid assets, making them liquid on a global financial fabric that's really the fabric of the future for financial services. So those are the 3 largest trends that we see.
Okay, that's great. Thank you, Duncan. As a practitioner, what do you see? Obviously, you're right in it. But around you, what do you see?
Well, I think it's nice to follow Sean on this point, because certainly institutions, when they come to this market, first off start by getting data and making sure that they can validate how they can execute, and whether their strategies apply to this asset class as well. So look, I think expanding on what Sean said, I think it's really important to separate out the crypto side, which we think of as the first liquid asset class on blockchain or DLT, and what's going on from a tokenization standpoint, where we see our traditional asset classes that we operate within moving or migrating to the form of a token, which can settle on these on chain. So I think from a crypto perspective, look, TP ICAP, we're a wholesale venue, so we don't face retail. So we've had products operating in crypto since the start of 2020. So there's definitely institutional trading in crypto. We start predominantly, it did start on the sort of crypto derivative side. We are the largest voice broker on top of the CME product, so we have a very healthy market share there. I think what I would say in general is institutional. We've seen a lot of our traditional customers who've come from, say, the commodities asset class, FX, as well as some like hedge funds and asset managers who've brought trading strategies that they apply in other asset classes across to the crypto ecosystem. You know, there's volatility there. It's a place you can speculate. And I think that they found some success bringing those trading strategies to crypto. We've only just, I think, got to the stage now where we're starting to see more what I would classify as kind of wholesale use cases of crypto, where clients are hedging into crypto markets. So I mean, typically in crypto, we've always had the miners and the staking firms that support the networks themselves, that have a natural sell pressure on the market because they're receiving their rewards in crypto. But we're starting to see now the early stages of firms like energy firms that mine Bitcoin with spare electricity capacity, or corporates that build customer engagement with their clients through the issuing NFTs that have treasuries in crypto off the back of it. That's what I'd see as more institutional clients coming to the market that we see in more traditional wholesale markets. On the sort of tokenization side of things, I mean, I think that is predominantly being driven by the banks, the asset managers, because they sense a real opportunity to collapse down their operational costs. If you can settle trades on a T0 basis, you can program the settlement to a much shorter time scale. You can reduce fail rates by using automation on the technology itself. I think that can really cut into the operational burden that banks and eventually that will get passed on to the investors themselves. But I think the industry senses a real opportunity there. And those institutional investors that are holding those products, I think they're ones that like to be forward thinking, understand that it's going to take a while for this infrastructure to get built out, but want to work with the banks, the tokenization platforms on holding a digital bond and being an early market adopter. Because I think from what we've heard, that they understand if they move early on that side of things, they get an opportunity to kind of define the landscape and work collaboratively with the banks, the intermediaries, you know, people like Ben and Marco at SDX and ourselves on how to structure this infrastructure. If you take a wait and see approach as an institutional investor, then you kind of can come to market later. But by that point, the infrastructure has been built out.
Let's see where our audience is, if we may. Thank you. Duncan, does that look likely to you?
Yeah, I would say in general, you know, if we were looking at the bell curve of adoption, we've definitely gone through the like the early adopters who came to the market, probably many of them in the 2017 to sort of 2020 early bull run. And then I think now what we expect, now that we've got a bit of positivity back within crypto and digital assets, and you know, you've got a big trend with tokenization at the moment, you know, we're probably moving into the kind of early adopter side of things, or the early majority side of things of institutional investors.
That's
Looking
great.
like
Very much.
everybody's in right there.
Sorry? Excellent. Thank you. Let's move on then, and let me come back to you, Ben. We talked a little bit about infrastructure, but how is the infrastructure developing? As Duncan said, it'll be, I don't know what we've made in a day, but it is developing. It will be sort of there, never ends, I know, but how is it now?
Well, it's interesting. I think, as Marco pointed out, and as we sort of talked about earlier, there's often a focus on technology, and the A-Team group is fantastic when we think about technology trends. But at the end of the day, for financial services, we're almost entirely underpinned by the legal processes and the law. And particularly when it comes to the nitty-gritty of digital assets, in the end, it's pipes and plumbing that relate to clearing and settlement. And as my external counsel is fond of telling me, building a clearinghouse, it's 70% legal, and the rest of it's your rule book. So it's all legal. And that's kind of another way of saying, the technology is pretty good now. There are a lot of firms out there who've solved many of the private distributed ledger problems. The public DLTs stand up, they don't fall over. We've solved many of the ways of even mining assets without having to do proof of work. The world has moved that to proof of stake. It has nothing to do with me. But those technological problems have been, I would say, mostly solved. As Marco pointed out, interoperability becomes a new question. Now, is that a technology problem or is that really a legal question? And I would suggest at the moment it's now the legal side of things that needs to catch up. I know I'm harp on about the UK, but it's interesting because we have places like the Law Society that get asked their view of how English common law can accept or not parts of digital assets and whether the law today can accept it. English law is very different to civil law because it's built on a number of rulings over time by the courts, unlike US law. Sean will be used to, which is fundamentally a civil law code. But very different way of approaching things. And the general view is that English common law can cope with this, but we may need a couple of tweaks. It's a moving process, and I would say we are getting close, but not there, to the end of that process of understanding how to integrate digital assets into the existing norms and means of financial market infrastructure. And that's going to open up all the ways we expect things to work. You are going to be able to repo a digital bond. You are going to be able to repo a real world asset, be that a packet of loans, in the way you would expect. You're going to be able to hold them in a tri-party arrangement. Interestingly, you're going to be able to fractionalize holdings in a building, probably. You're going to be able to transfer private shares. You're going to be able to do all the things that every startup you've ever heard of has promised is possible with the technology, but the legal underpinnings are going to be there. So, I think for me, that's really the state of the infrastructure, is that we can do it technically, we can pretty much do it legally. And now for some of us, Marco and I included, we'll have to demonstrate to the regulators that this all hangs together and you can trust us, please, that we can support systemically important pieces of market infrastructure. And that's where we're at, is now demonstrating to those that matter that this is really ready for the big time.
Okay, thanks, Ben. Sean, what would you add to that?
Yeah, Ben, it's great to follow you on that. I mean, I think as the market's evolving and the rules and regulation are being put in place and all the venues are becoming more mature and responsible, digital assets is unique from, say, equities in that it's much more like FX. There's hundreds of exchanges. There's really about 30 that's 97% of all trading volumes, with that 7 of them being derivatives exchanges. Those are the centralized trading venues. From a blockchain perspective, there's only like 5 blockchains that really matter. All of the decentralized protocols and what have you are trading on them. And what is radically different about digital assets is the amount of transparency that it's available. And because many of the spot assets are fungible across any exchanges, the behavior and price action happens. There's local prices that happen on certain venues at certain times. So from an infrastructure perspective, to really understand what's going on in a market, you need to be able to see global liquidity, market depth at different times of day across different venues, and contextualize that with what's happening in the derivatives market around the clock, the impacts of liquidations, as well as the underlying assets, how they're priced. So many assets and digital assets are not priced in US dollars. they're quoted in stablecoin pairs. So understanding what's happening with stablecoins, with velocity in stablecoins, with depegging of stablecoins, that can cascade through the entire environment. So understanding what's happening on chain, what has happened on chain, what's happening in various different centralized trading venues, it's radically transparent what is available in digital assets, and that's what Amber Data does. Is we provide that visibility across every venue and every blockchain to understand, so you can make informed decisions and quantify your opportunity and risk.
Okay, that's great. We've touched on regulation, but coming back to you, Duncan, if I may, what is the regulatory interest here, and what regulations do we have, and what might we expect?
It's a good question. What I would say from a TP ICAP perspective is we've there is a lot of regulatory flux in this area. So we work very closely with our sort of regulatory affairs team to stay abreast of evolving regulatory trends, both on the crypto asset side and on the tokenization side. I think certainly on crypto assets, we're in a transition phase at the moment where regulatory frameworks are coming into place globally, and they will come into place at different times in different regions. And there is somewhat a competition in place between different jurisdictions to court crypto asset spot business. I mean, certainly we're a UK headquartered company. Here there was a FCA, AML and CTF registration that you are required to achieve, and current guidance indicates that it will become regulated activity next year, and that's starting to filter out now how that regime is likely to look. Over in Europe, we know markets in crypto assets for spot crypto assets is coming into a place next year. The US is more challenging. There's still debates over what is a security, what isn't. But you have to, as a practitioner within the space, I think you have to be relatively flexible and adjust to the changing regulatory regimes globally. I think from a derivatives perspective in crypto, it's been slightly clearer. A derivative is a derivative. It largely falls under existing derivatives regulation. So that was somewhat easier to mobilize for us as a business. And I think from two things I'd call out on the tokenization side of things is, there are now some different sandbox environments that are in place or coming to market that allow financial market intermediaries such as ourselves to test our infrastructure on DLT or blockchain technology. And look, we're not going to be able to give an exhaustive list of all of the different opportunities and regulatory frameworks globally, but two I'd call out in particular are the EU DLT pilot regime, which started in March this year within Europe. So that allows sort of MTFs or CSDs, central securities depositories or multilateral trading facilities, to enter into a sandbox environment to run, and it calls out specific assets like securities in general, money market funds, equities, bonds, and allows you to run your services on some form of chain. And you can do that either as a market, a CSD-like product, or as a combined trading and settlement system. So that's like a really interesting area that allows firms to experiment with this technology. The other one I'll call out is we're expecting something similar in the UK, like a digital sandbox. But there's a lot of different regulatory environments. Say, like I'd call out Singapore as well, where they're very friendly, and there's been a lot of pilots coming out of that zone as well. So,
okay, that's great. Marco, what would you add to that from your perspective?
Now, coming back briefly to what Ben said earlier, I think I couldn't agree more with what Ben said before. I think it's highly connected to the developments in the regulatory space. I mean, at SDX, we very often think about the development of the roles and responsibilities of the market structure, obviously, in particular for an FMI such as ourselves in this space. And we actually went back to the root of the very term financial market infrastructure and looking at what does the actual word infrastructure mean. And found out the very origin of the word is made from Latin out of infra to stand for beneath or underneath, and structure to mean arrangement of parts or making by joining together. So in a way, the infrastructure of financial markets is by definition something that supports the arrangement of the market structure by providing foundational services beneath it. And this is fundamentally about enablement, I would say. Now, as mentioned earlier, I think very well, in the technical or operational sense, you can, of course, use the blockchain to represent this infrastructure. But a blockchain is a technology. It's not a legal entity. It's not an operating entity. You can contract with the blockchain or hold the blockchain liable, of course. So that's why infrastructure has a meaning at different layers, as Ben mentioned very well before, at the technical but also legal layer. And that's what an FMI is about, in my opinion, providing the legal foundation beneath the financial market structure to facilitate its arrangement through sound governance. Now, coming to the regulatory development, I think Duncan outlined very well the current developments in Europe and UK with the DLT pilot regime and MiCA coming up, mostly still for the pilot regime in a sandbox environment. I can speak about Switzerland or add on that about Switzerland, saying already as of 2021, there was the introduction of the so-called DLT Act over here in Switzerland, where we skipped the sandbox part, I would say, and we already have a new type of trading facility introduced called the DLT trading facility, which is a combination similar to the pilot regime. I would say it's a combination between a trading venue and a settlement system, CSD. You could combine the two things a little bit, which is enabling to service a new type of securities defined in the Swiss regulation called register-based securities or DLT securities. So this is emerging. I mean, the legal basis is there since a while, and we can see services emerging definitely in this space, be it with companies tokenizing their equity in form of this kind of DLT securities, or service providers emerging there. In general, I would say that I would concur with Duncan saying that there is a lot of activity, sometimes fragmented at different speeds, geographically speaking. Probably some healthy competition as well. Yeah, although I cannot speak for them, probably. I would say, but I think the regulators, I can clearly see them taking a central role in this innovative space. And being very active about it. I think looking forward, there will be a need to look at harmonizing some of these concepts. So think again about the word interoperability. It's not just about tech. It's not just about the piping, so to say, but it's also at the level of regulatory compatibility, ensuring from an investor perspective that what you're holding is what you think you're holding from its legal nature, ensuring that you are granted the same investor protection scheme, for example, no matter where you buy in a cross-border setting, for example. So these, I think, will be important focal points going forward.
Okay, that's great. I think, Sean, you wanted to add a word there?
Yeah, I do. I think actually Marco made one of the points I wanted to make, but I think that it's about the competition in the regulatory landscape. It really is. So today, the United States has a fairly negative posture against digital assets. I think I've spent a lot of time in DC lately, and I think that's changing, and I'm very optimistic that the ETF will get approved soon, etc. there. However, while over the last year, it's been a bit of a hostile environment in the United States, kudos to the UK. The FCA has done a phenomenal job, which Ben already talked about. Switzerland's always done a good job, as Marco mentioned. In addition to those venues, Singapore, they've got Project Guardian, they've got Project Orchid. They're doing the whole transformation of digital assets as kind of next gen infrastructure and pulling in all of the largest banks in cooperation with the Monetary Authority of Singapore. Very avant-garde, very pro digital assets, maybe not pro crypto as much as digital assets in general, right? And then if you look at Abu Dhabi, ADGM, these guys are really getting it. They really understand that they're trying to attract capital, attract institutions, and attract people to build businesses there. They are incredibly pro digital assets, and to the point that they actually participate on the basis points in the trades that are so that they can see both sides of the trade from a trade surveillance perspective. We've got a lot of customers that have moved from the United States or other regions to Abu Dhabi. Same with Vara in Dubai. Vara is where Deribit's setting up shop over there. Binance has set up shop there. They've got about 8 other entities that are regulated entities. Again, very clear regulation. And I think that the general theme, as Marco called out, is this is a competitive environment, and people will go where they're welcome, and the laws are clear because nobody wants to get in trouble with the law. We're all just trying to build businesses and capitalize on the future. So I think it's really on the US to get it together and either get out of the way or step out of the program, because the rest of the world has moved forward and it's very clear. So I'm very bullish globally, actually more bullish now this year than I've ever been institutionally, because there's such regulatory clarity across the entire world. So it's incredibly exciting.
Okay, excellent. Ben, would you like to just close out this question, I beg your pardon, with a few of your points and the kinds of regs we are looking at?
Sorry, I missed the end of that, Sarah, with a few points
the
on
kind of regulations that we're talking about.
Yes, I think just to summarize that situation, depending on who you're trying to face, you'll have different challenges and how you're trying to face them. I think it's very easy, and it's probably appropriate to think about retail separately to wholesale institutions. Retail is always different, has always been different in financial markets. Retail protections are much greater, and in general required. It is a phenomenal fact that new organizations have been able to spin themselves up in a couple of years and create retail trading behemoths from almost nothing. Many of those offshore. That's kind of outside of our world as wholesale counterparties and wholesale institutions, but you can't get away from the fact that there is massive amounts of liquidity created by those environments. A lot of that follows the sort of COVID trend. We saw things like Robinhood for stocks. We've seen the equivalent offshore. But of course, those firms have found themselves stepping into onshore jurisdictions and have found themselves subject to that onshore regulation and those onshore rules. I think you will now find that regulation will now follow the original standards, if you like, of financial markets. I don't think we're going to see separation of crypto assets from traditional financial market regulation in the majority of the developed markets. I know that was what was pushed for, and I know that that's what's being created in a number of jurisdictions with a view of trying to attract business into those jurisdictions. But now, you're seeing the catch up. As Marco pointed out in Switzerland, that was the way Switzerland operated, the way the UK has operated. I suspect it'll be the way the US will operate, although they do need to, deliver, the differentiation between a security and a crypto asset, probably from a civil law point of view. But once it's done, everything will just fall into scope for CFTC and SEC. I doubt you're going to have a separately regulated FINRA equivalent for crypto asset firms. You'll just be under FINRA or you'll be under the NFA. So I think in the long run, crypto assets for wholesale institutions and institutional participants will just look like financial markets as was, but on new infrastructure with some really new, cool, innovative ways of running cap tables. You just can't get away from how blockchains operate. They are quite interesting and create ways of owning and governing infrastructure and institutions that we have never seen before. But I just point out, owning Ether is, and this is controversial, it's not that different to owning a stake in a company, but being able to pay for the services with the shares of that company. You couldn't do that when we had a joint stock company first created, 400 years ago, because you had to write it all down on parchment and hand it around. Now you can hand it around instantaneously, and that just provides new ways of paying for things. It's an evolution in many ways, although many would want to call it a complete revolution.
Okay, fine. Okay, back to our audience and another poll question for you. And what are the challenges of trading in digital assets markets at your organization? And you can tick as many boxes as are appropriate to your organization. And while you do that, let me come back to Sean to ask him how he sees challenges of trading in digital assets for institutional investors. This was a very practical issue.
Yeah, so and I think first, digital assets, I think to Ben's point, are more like traditional financial assets than most people think. And so what we see is our TradFi asset managers, market makers, quantitatively focused firms come in and they're kind of like, they're getting their toes wet, and all of a sudden they're like all the way in the pool because they're like, oh, I get this. This looks just like what I know. Now, where are the differences and what are the challenges is, first, spot markets are highly fragmented, and it's much more like FX than it is like equities. There's various venues around the world, and liquidity at those venues might be light at certain times of days. And because these assets are fungible, you can get price dislocations that happen at an exchange, and those ultimately propagate through a market. So if you're an institutional investor and you're like, hey, I can't actually hold crypto, but I want price exposure, I'm going to trade on CME, you still actually need to care what is going on the spot market across 10 different exchanges around the world, around the clock, as well as you need to care a lot about what's going on in Deribit, which is the largest derivatives exchange. You can't only look at CME and just say, it's only here that matters. The reality is a global market that is fairly fragmented, and probably 50% of trading activity is some form of arbitrage, whether that be across centralized exchanges via spot markets or across yield curves or across decentralized exchanges, because decentralized exchanges don't work without centralized exchanges to arb against. So you have to be aware of these relationships and the impact in a specific locality that can propagate across the whole ecosystem. And then lastly, as I talked about earlier, the whole stable coin where everything is quoted in stable coins for the most part. By 70% of assets are quoted in stable coins. You really need to understand. So when Silicon Valley Bank failed, there was $3.3 billion locked in Silicon Valley Bank's vault, which was on USDC's balance sheet. So on Circle's balance sheet, that depegged on one exchange down to 83 cents. Coinbase was still like 90 something cents. But that depegging of one exchange caused a pretty significant impact. And if you were holding that risk on your balance sheet, when the asset that you're quoted in depegs by 13%, it's a pretty big deal, right? So you need to be aware of these relationships and have the data to inform your decisions, to quantify your risk and to manage your operations.
Okay, thank you, Marco. What would you add there in terms of challenges?
I think one of the main ones Sean covered very, very well. I was about to say that some of the main challenges I think really have to do with what we also mentioned earlier, properly assessing and categorizing the asset and the risk profile of what you're doing, of what you're transacting with, of what you're receiving or expect to receive when trading digital assets. I think that does it offer the same risk quality of traditional securities? Oftentimes, yes. Sometimes maybe not. Maybe it's different, especially on the payment part. Speaking of stable coins or other means of payment, absolutely. So what is the legal nature of that asset? We mentioned before, is it a claim? What is the claim against whom exactly? Is the representation of another thing? So actually is a claim of a claim, maybe even worse. So those kind of questions I think are important to understand. It has a lot to do with education, standardization and the likes, but it's important to think about those things. Another challenge I would bring up is from a practical point of view, more like is I think Ben mentioned before the instantaneous nature of settlements in this space, or rather I would say we see more and more a compression in time between trade execution and settlement, all the way to atomic swaps on DeFi protocols and the likes. Now, this brings a lot of advantages, obviously, a lot of novelty. To the point, however, I would say that from a trader perspective, that brings also a new paradigm, a new way of thinking. Because nowadays, as a trader, you care obviously about the execution and not really about the settlement, which takes care 1-2 days later or more. So there is plenty of time, or enough time, at least in most cases, to organize settlement activity properly from the back office. Now, this changes, obviously. So this brings in the thoughts about, from a trader point of view, about funding, for example. How do you ensure that you have the right assets at the right place at the right time at the time of trade execution, at the time of order entry, actually, at sometimes. So this is clearly something different, a new mindset, and I think it can pose a challenge in revisiting existing processes and methods today.
Okay. Duncan, as a practitioner, what would you say are there some of the challenges?
Yeah, a few I'd call out in addition to those discussed. One, we still see from prospective clients an education and investment thesis, and how do we get top of the house support to enter this asset class. It has had certainly crypto has had a checkered history. There are misperceptions in the market around crypto in general, and I think that where we've seen success, it's alignment between trading's operations team and internal control functions with senior management, and that isn't always easy to achieve. I think also, to expand on what Marco said, I think one of the things we looked at TP ICAP is we felt like blockchain and DLT tech at its heart is a similar sort of disruptive technology that you could compare to the, say, like electronification of markets in general. However, rather than it being largely front office focused, it's largely, back office operations, post-trade side of things. It's a step change improvement if it plays out as we expect to the way settlement works. So what that means is when a lot of clients come to trade digital assets, a lot of the trading technology feels similar. We're still talking about requests for quotes, central limit order books, going through order management systems, using algo execution, as well as some of the OTC desks that have sort of more voice hybrid kind of offerings. But that side feels very familiar. Where we often see a stumbling block is on that post-trade side, because you are moving collateral from digital custody in digital wallets, which is not technology or operational capabilities that most firms have. So they have to go through, sub-custodying with a new custodian, or building in-house, or going to a new digital custodian because their custodian doesn't support the digital assets. And I think one of the things that we see that's interesting is, in traditional securities markets, there's a general move to shorten settlement times, things like CSDR regulation, to try and compress settlement times for well-known reasons. I think one of the challenges of digital assets is if you want to settle on very short time horizons, you need to manage and have collateral available to do that. That's like a real turning on the head the way that operational teams work currently, where they, the trading front office teams trade, and then there's a process behind the scenes of, okay, have we got enough collateral to meet that delivery? Do we need to go and borrow off the street? What's failing into us? How do we settle that out? If you want to do this on a 10-minute, 1-hour basis, you're going to have to think more about what collateral do we have first before trading, or do we have pre-borrow in place before? And whilst that feels somewhat capital intensive, the benefits are, and what we hear from a lot of trading clients is, well, if you can trade and settle within an hour, that means your asset utility goes up. You can deploy a strategy, you can get a new asset in, you can go trade something else, and you can cycle through that collateral multiple times a day, which would be a significant improvement to the way markets currently operate.
Okay, thank you very much indeed. And let's see if we can see those poll results, please. And Sean, you might like to comment here. Oh yes, right. Might you expect this rather? Sean, you're on mute. That's it. Could you like?
I'm sorry, I didn't get the question.
Yeah, would you like to comment on this poll result? Obviously, staying a shortage of clear regulation seems to be a challenge.
Yeah, I think, but I think that's that's been the perception, but I think that's changed a lot this year, and I think that definitely there's fragmentation in the market, but that's also opportunity. So.
Okay, lovely. Let's move on, and I'm going to move on to a question about what you're going to need to do this. So, Sean, digging a bit deeper, what the firms build or buy, what technologies, solutions, and services are necessary for an optimal digital assets solution?
Yeah, I mean, really, this is what we built the business for at Amber Data on is, we recognized early on that it's just incredibly expensive, incredibly complex to connect into every venue that matters from a centralized spot options futures exchange, as well as on-chain data. And, even though on-chain data, hey, it's all public and free and anybody can collect it, but to gather meaningful information, insight for either who held what, when, at what price, from an accounting perspective, or from a fundamental perspective to understand global liquidity available in a decentralized exchange versus a centralized exchange, and what's the price impact of a trade in a centralized exchange or a decentralized exchange. That's incredibly complex to do and really difficult. And a year and a half ago or 2 years ago, a lot of firms thought, hey, we're going to build this ourselves. Then they realize it's going to take me 2 to 3 years and $10 to $20 million. And geez, I really don't want to do that. So that's where I think all of us here come forward with solutions that help people get access to liquidity or better clearing services, or, for us, it's digital assets data and market intelligence to understand. So I think it's clearly nobody builds the infrastructure, even big firms today. They come to the people who've been doing this for a long time. And that's what we do for some of the largest asset managers, financial services firms, auditors, regulators, even today.
Okay. Coming back to you, Duncan, from a sort of a practical perspective, how did you set this up, and what were you doing in-house and not in-house?
I think some of the things we've had to look at are like, how do you do analysis of the chains themselves, public or private, and building in-house expertise on that side. And there's certainly a range of vendors that can help on that side. But whether it's the assets we want to list, and we're starting to see this from regulators coming in, enforcing that venues do the appropriate due diligence on not just the asset itself and its mechanics, and the investment team, a little bit like the way traditional exchanges are pushed to do due diligence on a security during an IPO process, something in that sort of theme. But in this case, it also has additional requirements to look at the actual chain and the health of the chain that the asset is issued on. For a trading firm, I think I would expand on what I said previously about the post-trade side of things. That's often very different for a firm. And I think, what we see from our clients is a sort of a vendor custody process that goes on, where they look at, do we build this? Do we buy it? Do we custody with an external qualified custodian? Do we self-custody through a technology solution? I'll probably see less firms saying they're going to build it at this stage, but probably later on in the market, where there's a lot of solutions out there. But I think there are clients out there that are willing to engage in new digital custody, but that feels a bit strange, because you might be holding all of your traditional assets with your major custodian, and then you have a niche digital asset custodian on the side, and it's how do you reconcile between the two? I think we see a lot of our trading firms who would prefer to wait until their traditional custodians also offer digital custody services, either for crypto or tokenized securities. So there are a couple of things that I would call out on this point.
Okay.
I think another piece that I forgot to mention as well is how do you settle on these assets, whether you're striking NAV or you're settling a derivatives contract. So our customer for years have been asking to come out with a better reference rate. There's several reference rates in the market. There's a whole slew of reasons why people don't like them and don't trust them, or they create risk that's unnecessary. Today we announced a new reference rate, which will allow people it's gap aligned, it's IOSCO compliant, it's everything you need to be able to calculate your NAV for the assets that you're holding, or to settle a derivatives contract, etc. But it's a real need in the market, because what's the price of Bitcoin? Well, on what exchange? And then how do you, there's a whole series of things that you need to consider, especially when you're settling derivatives and things that are leveraged products in a can be highly volatile market.
Okay, thank you for that. Let's take a little short break for a few audience questions. We do have some here. And Ben, first to you. Roughly when does the panel expect digital asset markets to be highly tradable?
It depends which ones we're talking about. So let's just break into three. So for unbacked crypto assets, so cryptocurrencies, digital securities, and then let's call it real world assets. So the everything else, $100 trillion of assets that will get tokenized. So I think for the first one, you can trade it today, no problem. Question is, who do you want to face and how do you want to run your infrastructure? There are very basic prosaic problems, like you cannot settle Bitcoin without doing a free of payment if you want to do an on-chain settlement. Not possible, right? So in that sense, you probably want to be wrapped up with somebody else who's a fiduciary who can sort that out for you. That's why Duncan's on the line. He can fix that for you. Use someone like that. When it comes to securities, the law is there, but the fractionalization and those processes aren't quite there. You can do fractionalized shares in Europe, but it's not really digital asset sort of friendly yet, not there yet. So I would say, tokenized BMW, tokenized Apple, fractionally trading 24/7, probably 5 years away or so, but it will happen and it will be available on a global basis. Liquidity in other assets. I'm personally not a believer in the electronification of those assets causing high volumes of trading. I do think it will make a massive difference to liquidity though, but it'll generally be around repos and those sorts of transactions that will allow the liquidation or the raising of cash against assets that have been well defined. I think that's a 5 years or so process as well. But it's really, in the real world asset case, it's more about what of why bother tokenizing. Tokenizing it just for the sake of doing it, to have a registered, it doesn't really change anything from the PDFs that you can have today, right? Being able to use those to raise cash against the asset instantaneously on a Saturday, that's a whole different world, and that's a really good sort of so what.
Okay, lovely. And Duncan, one for you here. It says digital assets come with problems such as high volatility, regulatory uncertainty, and technical complexity. So how can firms win management buy-in to trade digital assets?
That is a big question, isn't it? What do I think? Look, I think volatility in crypto. We sit in an energy and commodities franchise, as I mentioned before. You'd be surprised, particularly this summer, we had the lowest volatility in crypto than we've ever had, and it is more comparable stroke less than some of our commodities products that we're involved in. Look, I think the challenges are different depending on, as Ben said, who you face, how you operate. So going to management and saying, I want to trade on a sort of niche exchange that operates in a jurisdiction where there isn't a major financial jurisdiction that I face directly, that's maybe had some issues previously. That's very different to saying you want to trade a cash settled derivative on one of the world's biggest regulated exchanges. And there's a whole plethora of different market infrastructures in between, with their different profiles in general. And then I would say it's about the investment thesis. Why is it you're coming to this asset class? Is it because you think you can you bring down your cost of transacting by using a digital product instead of a traditional product on the security side of things or the real world asset side of things? Or, do you think that your trading models work in crypto and you can port them across from another asset class? That side of thing is going to be down to the individual firm. One point I would add just on Ben's previous point, one of the things that we like to think about at TP ICAP is that blockchain infrastructure gives you access to a different type of investor. There are certain demographics that like to engage with their financial products as a token, and that's going to increase over time. So whilst I agree with Ben on the timelines for beyond crypto, like securities and real world assets existing as tokens, one way of thinking about it is that actually there are investors, people who want to engage with financial products that just come through this distribution route, which is a digital token and on-chain rails, and they, just like they want to engage in Bitcoin or Ethereum, they also want to have access to money market funds or bonds, or they want to maybe buy shares, and actually they would prefer to do that route than they would go and open an investment account somewhere else, or do it through contract for differences. And it's just a different way for people to engage in financial product.
Okay, thank you, Sean. And one for you. Let's have some quick answers here, I think. At the moment, does the panel think it is wise or unwise for FIs to build a digital assets line of business?
I think I can start there. I think that anybody that doesn't have an eye on digital assets is going to miss the biggest transformation in financial markets. And this is like looking at the internet in 1999 and saying doesn't matter. This will touch every person and every, person on the planet, and everybody who has a cell phone. It will bring new financial products, and it will it's gonna be massively transformational. So anybody that's not paying attention is irrelevant.
Okay, thank you. And a very quick one for you, if I may, Marco. It asks, what types of digital assets are yielding profits?
Well, I think it's a matter of also the historical point in time we are in. I think if you, depending on where you are in the market, obviously, but if you look at the crypto side of things, cryptocurrencies and the associated volatility, depending on where you are in the market, that can that can lead you profits. Now, whether that is institutional or has been leveraged at the institutional grade, I think rather not, or not so as much. Speaking of digital securities themselves, my perception is that at this point in time, it's more about efficiency and efficiency in the structuring and issuance process and processing of digital assets from a profit point of view, margin point of view, more than so from a trading activity point of view. That's a bit the broad view at this point in time for digital securities, I would say.
Okay. Thank you to our audience for your questions, indeed, and thank you indeed to our speakers for the answers. We are so running out of time now. This is really interesting, but let's bring it all together if we can. And I'd like to ask all our speakers to offer some advice to our listeners about what they should be doing at the moment in this particular space. And let me come back to you, Marco. Would you like to lead out with this one?
Yeah, sure. So in a nutshell, I would say, well, look into your own organization, look at your strategy and priorities. And I'm not talking just about digital asset strategy, I'm talking your strategy in general. Think about what would be a good application in your mind about digital assets and such services. For example, is it about simplifying or consolidating a process? Is it an efficiency case? Is it about improving a service being offered today, or, for example, making it accessible to a broader customer base, as mentioned before by Duncan, or making it faster, or 24/7 availability? So is it service enhancement? Or why not? Is it about offering a whole new service to capture a whole new market share by offering, for example, trading of previously non-tradable or hardly bankable assets, the real-world assets as before, although there are some still questions about liquidity aspects of that. So is it about addressing new customer segments and targeting new revenue streams? So based on that, I can only tell you, find your nearest business manager and digital asset head, present your case, and try to get into the next year's budget planning. Maybe late for next year, but the earliest convenience. Because I think now is the time for innovation and for bringing up commercial use cases. So I can, from where I stand, I think the time for pure experiments is over.
Okay. Ben, a few quick words from you, please.
Sure. I think in general, you should, if you look into digital assets and you look into crypto assets, you'll find it very familiar to what you're already used to. As Duncan and Sean have pointed out, there are differences, but many of those differences are being overcome either through regulation that is becoming clearer every day, and as we said, in some jurisdictions is already there, or through intermediaries, the ones that you're used to, who will solve a lot of those operational problems for you. And I think, lastly, there are plenty of professional services and firms and financial institutions out there that are providing services in the usual way. So it's not just the Wild West anymore. It very much is, traditional finance people and players providing traditional finance services, but in a brand new set of technologies.
Okay, Sean, some final words from you.
Yeah, absolutely. So I think, following on what Ben and Marco and Duncan have said is like, first, pick something that you know, and then go look at what's different in digital assets and why. And then I think second is go read the regulation. One of our customers, Moody's, Rajiv, that runs the digital assets business over there, challenged me to go read all the regulations. And I did. And I was actually enlightened and excited after doing so. And then what for me was important was understanding every regulatory framework. What problem were they trying to solve, and what's behind it? Like, just ask yourself, why are they doing this? And what does this mean? And how does this change things? Right. And then I think the most important is digital assets is radically transparent. More transparent than any traditional financial market today. Look into on-chain data and start to understand it. Look into, if you come from TradFi, look into the derivatives market. It looks exactly like what you know. Just get smart. Like, don't guess. Look at the data, look at the market intelligence. If you don't, you're just guessing. Don't guess. The data's available, and there's people like us that provide that, and others. Get smart. This is going to change. This is going to be a massive transformation for the whole industry. So get involved.
Okay, thank you, Sean. Obviously, this is something we'll be coming back to, so we do have to finish here. So thank you very much indeed to Sean, Duncan, Ben and Marco. And thank you to Amber Data for sponsoring today's webinar. Just before we close, a couple of 18 Group items that may be of interest. You can download our very first institutional digital assets handbook from this year, 2023. You can register for our February 2024 Trading Tech Summit London, or our first webinar of 2024, which will look at best practice approaches to trade surveillance for market share abuse. That said, that's it for today. So once again, thank you to all our speakers, and thank you to all of you who took part in the webinar. Please complete our feedback form, as we're always keen to hear your views and improve our products. Meantime, thank you very much and goodbye.
Thank you.
Thank you, everyone.